Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Chubb Limited, ticker CB. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company is in the insurance industry. They have a market cap of $81 billion, enterprise value of $94 billion. So you have about a $13 billion of extra net debt leverage on this business. They provide insurance and reinsurance products worldwide. They operate in property and casualty insurance segment. They have a personal property and casualty insurance, so both commercial and personal. They also have an agricultural insurance. They do peril, crop hail insurance, and an overseas general insurance segment as well. They also have a reinsurance segment, so lots of different types. They have life insurance, basically a huge insurance company. Now, what's interesting when I look at this return on equity numbers is over the last 20 years, they do not have a single year with an annual loss. Again, I've said in so many of the episodes, if you can have 20 straight years of profits, you're almost immediately in my consideration for a high quality company. So I'm really liking what I see here to be relatively high quality. Now, it is an insurance company, so I'm not surprised that there's some cyclicality in some of these results because you're going to have some bad resulting years and you're going to have some good resulting years. So you're going to be up at 19%, down to 9%, 17%, down to 7%. So I'm not super surprised at the fact that you have some cyclicality. Now that cyclicality has leveled off recently, and I can see a somewhat downward trend. I don't really like this downward trending results. It looks like their results in the early 2000s were substantially better than their results since 2010, where they've kind of been at a lower average. So that's a little disconcerting, but 2021 appears to have been a really good year at 14% return on equity, and maybe you're going to get back to some of these higher numbers, 19, 17, 15%. Overall, though, this is a suggestion of a relatively high-quality company. Again, no losses, 20 straight years of profitability, really, really good sign. Now, in terms of the 10-year median returns, the returns are just a little bit low. You see this 10-year median return of 9.7%. I would really like a number above 15%. You do have numbers that show that you can get close to that, 13% in 2013, 14% in 2021, and you have a few years over 15%, but you're definitely not averaging out there. So it's a little low for what I'd be interested in necessarily for myself, but it looks like a really high quality company. It's just not pushing up those super high quality nature where you have those higher returns on equity. Now, PE ratio looks pretty attractive. PE of 10 is an attractive PE, especially for a company that's growing. Now, we're going to have to look to see how their dividends pay out and that sort of thing, but at least a quick cursory look here is that they have paid dividends every year for the last decade, and yet they've continued to grow revenue at 9%, premiums at 9%, assets at 9%, and EPS growing at 15%. So if you're getting a dividend paid out, which is, maybe 1 to 2% of the current stock price, so a 2% dividend plus 15% EPS growth, that's looking like a 15 to 17% annual return. And when you think about that in terms of a PE ratio of 10, that's a very attractive entry point that is worth considering. Now, that PE of 10 is based upon having this 2021 EPS of $19.27, but you can quickly look that this is completely out of line with what they have been returning over the previous 9 years. So maybe this PE of 10 is actually closer to a PE of 20 if you say simply just cut the PE in half, and that would be kind of more normalized with what they've been doing recently. Now, again, it's not like this that they've never hit these returns on equity before. They certainly have, but it's more suggestive of a cyclical top than something that I can necessarily rely on. Is that true here? It's hard to say. But you do have strong growth. You can see the revenue growing from 17.9 million to 40 billion, 15.6 billion to 36 billion on earned premiums. So they are steadily growing over time. And so it's not like I should just expect nothing from this. It's just really hard to tell whether or not it is sustainable. With all that said, on the surface, it appears cheap. I would say more likely it's closer to fair value on my valuation consideration. If you're enjoying this video so far, please hit the like button. Don't forget to subscribe. Your subscriptions help you get notifications as I upload new videos to the channel covering new companies as I work through the entire S&P 500. So ring that bell so you can get notified as I upload those videos. And please like the videos so that YouTube will suggest it to more other people to help me grow the channel. Now, We go to the income statement again. Insurance companies are going to be relatively different. One thing that's interesting is though the premiums are growing over time, their actual net investment income has basically cratered. They have almost no net investment income from 2017 to 2021, although it did flip and they have this fees and other income that's basically supplanted it. So I don't really know why that is. Maybe they've restated what those are. Maybe this was, the 2017 tax bills caused them to classify it differently, but otherwise you have those numbers doing well. You want to make sure you're getting some investment income in an insurance company that helps you to cover some of your expenses there, especially because you're going to see us also see these benefits and claims continually rising over time. Shares outstanding have risen over time, and you have a substantial jump from 2015 to 2016. I don't really like to see that, although I guess you have bought back shares since 2017. Looks like you were buying back shares before that too, but I'm assuming there's some sort of big acquisitions here in 2015. And let's see if we can see that on the balance sheet, or not the balance sheet. Let's see if we can see it on the cash flow statement. So you have pretty steady acquisitions or pieces here. You have some big investment. There's a big other here. It's not exactly clear what happened. Let's see. I don't see a big jump. Why did they issue so many shares? Do you have a big... Something's off here. So I'm a little questioning what's going on. I mean, these acquisitions are noting as blank, and yet every year before they had acquisitions. So I'm guessing some of this data maybe isn't completely reflecting what we'd like to see, which is okay. You can really see they're investing a bunch of cash into investments, and you should be getting a lot from that. They do buy back stock almost every year, which is what I do like to see, and they don't really have stock-based compensation, so that is good. They're definitely using a lot of their cash flow for stock buybacks. They're also doing dividends every year. So what's nice about this sort of capital allocation is you're getting buybacks, you're getting dividends every single year, and yet you're still growing revenue at 9%, and that's allowing you to boost your revenue from that 9% range to the EPS of 15%. And so when you start talking about 15% annual increases in EPS, that's a really attractive business to hold long term. So for me, this business is a little hard for me to understand, but I think it's something that will go on my watch list because I've been looking for insurance companies. 20 straight years of profits is really, really good. If they have turned the corner and this new profitability level is the ongoing profitability level, then the company is going to be very, very attractive. So I think Chubb Limited will go on my watch list. It's borderline because I'd like to see these return on equity numbers be a little higher, but we're starting to see clues that maybe they figured that out in 2021. And so it would take some deeper work to determine that, but otherwise I feel pretty good about this one. So if you like this video, please hit that like button. Don't forget to subscribe and ring the bell so you can get notified as I upload new videos covering new stocks each and every day of the week as I work through the whole S&P 500. Thank you for listening, and until next time, stop paying fees, start building wealth.